right there, cash open. Top edges, liquidity coming in. Quite a lot of liquidity coming in. Top edges, sell side only. You look at the linker coming in here. The linker opens very aggressively buy side. Selling top edges as much as you can. Selling top edges as much as you can. As the price drops down, you can see the linkers drops out a little bit. We book some profits. When the linker rallies back into the seller's agreement, we want to sell into that. There's the next sell. Boom. When the linker drops down, if it drops down any more, we're going to book some profits here. When we come off the linkers and we look at it from a inflation point of view, so we asked you to build an inflation model. So if you look at your own inflation model to see what it was doing, this is what the inflation model looks like. So you can see that the inflation model pops hard to the upside here. This is a sell on equities, guys. This is a sell on equities. What about JP Morgan's inflation model? JP Morgan's inflation model. This is a sell on equities. So when we see the JP Morgan's inflation model giving us a big sell on equities like this, we should be short equities, shouldn't we? It's part and parcel of what we understand to be the JP Morgan's trade setup. So when we understand it's part and parcel of that JP Morgan's trade setup, I'm a little bit surprised we haven't actually ran the bottom edges just yet. You know, we're waiting for that bottom edge to come in for that short sell. You know, so if this plays out, there's obviously a bit of a spread trade here. I mean, this trade here seems to be, if you're looking at this as a possible play, and it's still bullish, then of course this is still very definitely bearish on pullbacks. And you can obviously spread into those. You'd have to think about whether you want to hedge them or spread them. You know, you can try and go for double alpha value narratives. But obviously, if you want to hedge them, the idea is, of course, trading the hedge opportunity. So if you're looking at this as a buy trade, the idea is to obviously look to buy the S&P. But I don't like the price because it's too high a price. So that wouldn't be a good hedge. However, if I'm looking to buy the S&P, this would be a very good hedge to sell into now at the top edges, wouldn't it? This would be a possible better play to sell into this high price. Because obviously if this is real, if this buyer here is real, then that sell is a real money opportunity for me to sell JP Morgan's, buy NVIDIA. And that would give me a great spread trade right there, if I believe this to be correct. Now, what would cause that to be correct? Well, other information, right? The idea is that if this has gone too high, well, that's my trade, right? That's going to be my trade. Why would it have went too high? Well, because we can obviously look at other things. We can look at, for example, inflation break-evens. So when you look at inflation break-evens, they're nowhere near as high as this. Correct? They're nowhere near as high as that trade. So what are you going to do about it? Well, the best play would be to sell JP Morgan NVIDIA. There might even be a case to start buying some bottom edge S&P into that storyline. Now, I don't like that because this has got a far bigger premium than this market has as a discount. So I'm far better selling JP Morgans at higher prices against that NVIDIA spread. So if you're looking at the JP Morgan against NVIDIA spread, you'll see the sell coming in there. Look, we took out the liquidity of the prior spread high. There it is. There's your sell opportunity, isn't it? So as a spread trader, that's your deal. Selling off 9,000, currently trading 8,500. You've made $500 profit on one spread so far. $500 profit on a single spread. Nice. Nice quick scalp. It's a 5-minute chart. It's nice and easy. Great trade, right? What is the 5-year linkers? It's the ZF TIPX, 5-year linkers, ZF TIPX.